Hey, what's up, guys? How are you doing? Hope you're well. So, how much do you actually make when you invest in treasury bonds? All the time we talk about investing, we talk about treasury bonds, we talk about treasury bills. My last video was about the rates that we now have for treasury bonds, especially the infrastructure treasury bond that just came out. And of course, now there's a new one. I'll talk to you about that as well. But right now, if you want to actually invest in one, how much do you make? This question comes about a lot in my comment section from my clients, like, hey, can you tell me the specific amount of money I'll be putting into my pocket if I'm investing in this bond? Because at the end of the day, the money that doesn't get into your pocket isn't your money. So sometimes you invest in something, then you have to pay certain things. You can pay government, you can pay fees, you can pay management, you can pay, dealing fees, which is quite different as well. You can pay platform fees, which is different as well. You could be paying certain taxes, depending on the investment type, depending on jurisdiction as well. So what amount of money do you actually make from a treasury bond? And this is a good question because then it gives you a very clear overview of exactly what you expect when you're investing this kind of money. Because most people won't be investing millions and millions of money. Companies invest those ones. People who have high liquidity would invest those ones. But people who are starting to invest just want to start with something manageable. You want to start with something simple. So why did I choose 100,000 as like the base? I'm doing 100,000 because the minimum investment in a bond is usually 50,000. For a treasury bill, it's 100,000, weirdly enough. But now, the 50,000 you put in a bond as the minimum investment, I rarely encourage you to put that amount in bonds, especially if that bond is going to be for a very long time. And I'll explain why. If you take 100,000 Kenya shillings today and you lock it in a bond, which is, let's say, 20 years. For instance, the one that's open now is 25 years, right? So you have a bond that's open for 25 years. You take 100,000 as your investment, and then you put it in there for 25 years. Now, I do not see the sense of locking 100,000 for 25 years because it doesn't give you any significant returns. So you basically locked in your capital that could help you gain more money, make more cash flow much faster in a different investment vehicle, and also help you in, maybe when getting into a business, side hustle, or whatever. 100,000, if you lock it for a long time, you're going to lose most of the value of that money by the time you get it back. And above that, the interest rate you've been earning from it will be very limited as well. And remember, with treasury bonds, you can't compound. There's no compounding of treasury bonds. You basically invest that money, government locks it in, they pay you every single year. Okay, it's 6 months, so twice a year, right? For a single bond. So they pay you twice a year, every 6 months, and then, you do whatever you want with that money. So essentially, most people won't end up compounding that money. If you're smart enough, like I've taught you on this channel, and you've been an added follower, you would know that you always get that money, invest it in something else where you can compound money. That's how you remain rich. That's how you stay rich. I don't say you get that money, then spend it on, I don't know, just fun and stuff. Then you actually won't see the use of that money. So you have the 100,000 locked for 25 years. Do you want to lock your 100,000 for 25 years? Instead, you can put that money in a money market fund. You can put that money in a compounding place whereby you can compound. Doesn't have to be a money market fund. It can be anything, even crypto if you want to. You can risk it depending on your risk appetite. Even stocks if you want to, business if you want to, a side hustle if you want to, depending on what you want, right? Depending on how active you want to be with it as well. So why lock in 100,000 instead of using it to accumulate more money? Bonds are good and effective when you have some substantial amount of money. And substantial here would mean 500,000 plus, 500,000 Kenya shillings plus. So with that, at least you get to see some kind of cash flow, some kind of decent returns. Now with the rates going down as they are right now, it even makes less sense to lock in 100,000 for 25 years. I hope that makes sense. So just use that money somewhere where you can compound it. Compounding means each day you get 1,000, 2,000, 3,000, you can put into that investment, and then your 100,000 now starts getting you more money and more money and more money. Accumulate as much as you can to 500,000 or 1 million, and then you can transfer it into a bond. And now you can lock that bond because you're like, okay, now there's an investment that will give me something significant every single year or every 6 months, So that makes sense, right? Now, today we just want to look at 100,000 Kenya shillings invested, how much do you actually make? Let's get into my screen. I'm going to show you everything. I'm going to show you the one that's open now because we have the treasury bonds, the normal treasury bonds, and then we have the infrastructure bonds. So we're going to look at the two, how much you make if you are to invest 100,000 Kenya shillings. Let's get into my screen and let's go. So I'm gonna use Miro or Miro. How would you call that? It's Miro or Miro, whatever. It's just a board, definitely. I just want to show you exactly how to do these calculations. Now, before we get into the calculation, this is the one that is reopened, right? This is the new one right now. It's actually on sale from Friday up to 5th of March, right? So if you want to invest in this one, this is a fixed coupon treasury bond for 25 years, right? So that's why I was saying if you want to invest for 25 years, here you are. And then you have the infrastructure bond results that were released a few days ago. But anyways, like I told you, this is the one that has been reopened, 25 years one. This is the current one, active one that is currently being, you can bid on that. It's being auctioned. And then you have the one that was closed last week, and this was an IFB, this was infrastructure. So I'm doing these two examples so that you can clearly get the picture of what you can actually make depending on which bond you buy, because different bonds will, charge you differently in different ways. So we'll deal with that as we'll talk about that in a few. So cool. So let's start with this one, right? A normal bond. So this is just basically an example of a normal bond, right? I'm not going to delve into the details of this particular one, but the most important bit of this particular bond that we have to delve in is what are the charges, first of all, right? What are the charges? What is the return? Those are the main important stuff. If you're investing in something, you want to look at ROI, right? What's your return on investment? But net charges, because sometimes we say return on investment, but we are not netting off the charges, and therefore it looks like we're making a lot of money, and in real sense, you're not making a lot of money. So as a smart investor that follows Ken's Money Matters, you want to make sure that you are looking at the right thing, okay? So on this particular one, let's come. This is 25 years treasury bonds. That's a long time. Let me know in the comment section if you would actually lock in your money for 25 years. Let me know. Is that a lot, very long? And how much do you actually want to lock in for 25 years? And do you think it's a good idea to lock in your money for 25 years? Now, in real sense, actually, this won't be 25 years because if you look at the tenure here, it's 18 years. Why? Because it's a reopened bond that must have been 25 years. It was opened in 2018 the first time. So meaning, as we speak, it's done 7 years already. So they take the 7 years off the 25 years for the full tenure of the bond. So meaning someone who's buying it now has 18 years to go. But someone who bought it in 2018 did 25 years. Now, let me know if you could still do 18 years. Or if you just had a normal bond that would do 25 years, would you do it? Anyways, so the tenure here is 18 years left on this particular one. The coupon is 13.4, very important factor. So we look at the duration, we look at the coupon rate, we're looking at the withholding tax. In this case, you can see the withholding tax is 10%. Now, that's a very important bit. So now let's come back. And if you look at here, minimum investment is usually 50,000 Kenya shillings. And we're talking about 100,000 Kenya shillings investment because I still think you should invest a little bit more if you're going to do bonds. Now, let's come back to our impressive Miro board or Miro board, as you would wish to call it. Let me know what it is. Is it a Miro or Miro? What's the English term? Anyways, so we've said that this is a normal bond. It's a fixed coupon treasury bond. The return, as we've seen, is 13.4, right? So 13.4 is what you get. Yeah, that's going to be horrible, but fine, guys. 13.4 is your return, right? Then we know that there's a tax of 10%, which is actually lower than normal taxes we are charged on other stuff, right? 10%. Investing is good. You get to at least get a tax break of 5% on top. Because if you do a money market fund, you get 15% withholding tax, right? So here you have 10% as the withholding tax. You said it's 18 years, right? 18.3 years. That's the tenor. Wow, that's horrible writing. So 13.4% is the return, 10% is the withholding. This is the duration, right? Cool. 13%, if you look at that, we're going to do 13.4, divide that by 100, and then you multiply by what? 100K, because that's your investment. And then now you have your 13.4. Cool. 13.4, you're going to multiply by 1,000, and that is going to be equals and 100, so that's 13400. Right? This becomes your return. So annually, remember this is annual. This is annual. right? It's 13.4 annually. So annually from your 100,000, you're going to be paid 13,400 Kenya shillings in this case. Now, if you're being paid 13,400 Kenya shillings, right? From that particular interest, let's remove 10%. The government is going to take 1340 Kenya shillings. That's 12,060. So this is the return that you get, 12,060. Now remember, it's paid twice a year. Right? So you divide that, and what do you get at the end of the day? After every 6 months, what do you get? Divided by 2. So you divide that by 2, and what do you get? You get 60, 30. Now it means every 6 months you get 60, 30, and at the end of the year you have your 12,060 for this normal bond, right? For this normal bond. So yeah, that's what you get out of that. Now let's do, and then we check the IFB one, right? So wait, so on this particular one, we've established how much you're making of it. So it's basically just the tax that you're being charged. There's no other fee that you're paying unless there's a different, if you're using a broker, it's a different case, by the way. That's something to consider. If the broker is charging you, some brokers do actually charge you for them to bid on your behalf. So that's a different case. In your case, you have to establish that. But if you're just buying directly, that's what you're paying, okay? If you were to take an IFB, like this particular one, let's say the 17-year one, the coupon rate on this one is 14.39, so 14.4%, for instance. So 14.4 is your return. That's your return investment and zero tax, right? Zero and withholding tax. So here on this particular one, you get your 14.4%. You multiply that by your 100,000 investment. Okay, so 1440 times plus 1,000. Sorry, 14.4 times 1,000 gives you 14,400. Now 14,400. Now let me put this on a text. That's what you make of that infrastructure bond, right? Around there, it might be with some cents because it was 14.399. So this is what you make as your ROI on the IFB, and there's no tax. This one is IFB, giving you a return of 14.3%. This one is a normal bond, giving you a return of 13-point-something%. Now, we didn't compare apples for apples, obviously, because this one is giving you a lower return. Funny enough, the one that's being taxed is giving you a lower return at 13.9%, and the IFB one is giving you a higher return at 14.4%. Now, that means you're going to get more money, obviously, but if you were to compare apples for apples, you would still do the calculation on 13.3%, which I can do easily for you right now. Oh, remember I haven't divided 14,400 by 2. Then that would give you, divide by 2 here. Let's just do is, let me just show you so that you don't say, oh, if you divide by 2, what are you getting? You get there 7. So 7,200 every 6 months, right? Up here, you'd be getting your 13,400 per year divided by 2. If it was just IFB as well, you're getting that on to 6. Vendor 1, 700, 6,700, per 6 months. Now the difference isn't big, obviously, because you're talking about 100,000. And again, that gives you a clear overview of what you expect when you're investing that kind of money in a bond. Now tell me in the comment section below if you think this is a good deal or not, and if you think this is something worthy of investing on for like 20 years, 25 years or so. And if you think 100,000 is something you should invest in a bond, or is something you should put somewhere else and compound it, and then later you put it in the bond. Now with that kind of return, we're looking at with 100,000 invested, you're looking at that return of like 12,060 in a year for a fixed coupon bond, and for on IFB, you're looking at a return of, let's say, 14,400 a year. Is it worth it? And your money is locked for 20 years. I don't know. Tell me what you think. Now, if you were to even go down, you can change that into months, right? The 7,200 divided by 6 again, you bring it down to months. It's 1,000 and something. Is it worth it? Maybe. Like I always say, any income is important, but invest. Until next time, I'm out.